Hello everyone, hope you're well. So we get loads of questions from you about money and all manner of other things. And today we thought we'd just run through a load of them, get them answered.
Let's go. William wrote in, question for you both. When is the best time to sell stocks? What are the triggers to sell and why? Also, when is the best time to buy?
I think there's some really clear answers here. So the first of all is harking back to Sasha Yanchin, if it hits your target price. So if you said, I think that this investment is worth this amount and at the minute it's undervalued, once it hits that amount, you revalue it and you sell if it's at that price, right? The second thing is if something fundamentally changes about the business that changes your thesis or outlook. This could be sector specific or it could be the individual business itself. Let's say it comes out that the board are committing fraud. That's something you might not have known, so you exit. Another reason is you think that you can generate more returns in another investment. So you might have I bought this investment, company. I think it's going to do 10% in the next 2 years, but this one over here might do 500. I'm pretty confident, so I'm going to sell that for that. You sell it for a better thing. And the final one would be that you made a mistake, that you thought, oh God, I bought this at a time when I knew nothing about investing. I invested in this EV company because I thought, electric cars are the future, bro. And now I'm holding on to this massive bag and I don't really know why. That would be another reason. And then, you need the money. Is a pretty good reason to sell. But
but that can be painful.
Yeah, but if you need the money is what it's there for. But the one thing you don't sell for is it because it went down.
Yeah.
Because that shows that you have no understanding of what the fair value is of that investment. If the same with an index fund, all of that still applies with an index fund. If it goes down, that's not a reason to sell. I think with index funds, the one that's probably most common is someone's bought something they didn't realize or they want to tidy up their portfolio. I see people when they first start, they message me like, hi, I'm just getting started and this is what I've decided to buy. And it's like 15 funds. And it's like, UK small companies, UK large companies, Japanese bonds. And I'm like, what the hell are you doing? Like, why have you done that? And they're like, well, I just want to diversify a portfolio. And they've got a global fund in there as well. I'm like, you're already buying the world.
Heavily diversified.
And I think after a few years, they realize like, oh, I don't need all this crap. I could just buy that. And I think that, that maybe then at the point that you want to consolidate, but that falls into that category of you didn't know what you were doing and you need to sell. I don't think there's anything wrong with going, when I first started, I didn't know what I was doing. I don't know why I bought this really. I bought it because my mate told me to.
I think a lot of people can relate to that.
Yeah.
But I would say, the most important thing I think that you said out of all of that is, if you have a price target, you should sell, because I think everyone's been guilty. I've definitely been guilty.
Individual companies this applies to.
Yeah, if you have an individual, so you're like, okay, if it gets to $100, I'm gonna sell. It gets to 100, you're like, it's going to $200. You just keep holding on, or you buy more. You just keep thinking the rise is gonna go on forever. And then when it goes down, human nature's, oh, I'm losing my money. I better sell it before I lose more. Whereas you need to have a better understanding of your targets and
I find that hard though.
I think that's the hardest bit, when it goes down, you see negative and you're
going up.
Oh yeah.
So I bought Barclays shares recently and they're up about 40-50% since when I bought them. And I'm staring there going, I should just sell this and put it into the index because it's done really well. But I'm finding it hard to do that because the dividends are just so chunky. I don't know, it's done so well, like the emotional turmoil of letting it go and seeing it go up even more would just, I can sit here all day and say just do this,
but you're not meant to be emotional about your investments though.
Yeah, but I'm a human. Yeah, do you know what I mean? So, and yeah, the same with Alphabet. I've got a large Alphabet position and that's rallied because of the AI bubble or whatever. If it might not be a bubble, but the AI mania. And there's a large part of me that goes, I should probably step out of that and just put it into the index. This is why I just think buying individual companies, all these questions you have to ask yourself, that if you just buy the index, you don't have to ask yourself any of that. You can just get on with your day. Yeah, and by the way, when I talk about individual companies, that's only 10% of what I invest on a monthly basis. The majority of what I invest in every month is in a global index. That's probably why I sit there going, I'm not going to sell the Barclays, even though I should, because it's not a massive portion of my portfolio.
But you mentioned Sasha earlier. And he said, like, when you're looking at these companies, if you're trying to find a target price for a stock, or you need, the amount of work you need to put into is insane. You have to put hours and hours of research into the company to know what a good target price is. And like every day, every month, just constantly doing research. So it's not just picking one guy, I think it's going to go to $10. Like, you have to put in the work, do the company research, all of it.
Yeah, my target price is double. Why?
More.
Yeah, more. More?
Please, sir, can I have some more? Connor writes, is it wise to sell your investments when switching? Or is it better to just keep the portfolio and then build up the new one? Switching what? Switching girlfriends, switching houses, switching cars, switching outfits?
Switching, I think he means like if you're changing provider, if you're going to a different platform to invest in, should you switch over your investments from the old platform to the new one? Or if you're maybe saying, I'm going to buy a new fund now, should you switch from the old fund to the new fund, or should you just leave that pot where it was?
Cool. What do you reckon?
So it can be I think that it can be problematic changing out of one investment fund to another, because you can incur fees, first of all. So if you have a fund that's not listed in pounds, so it's a dollar or euro based fund, when you sell, you'll likely incur an FX fee for that. Yeah, if it's a pound listed fund, there shouldn't be any fees, so that should be pretty straightforward to do. So that's the first thing to consider. Am I going to pay fees to do this? If I was, I wouldn't do it. Like, it doesn't bother me. Secondly, if they don't offer the ability to transfer the portfolio from one platform to another, and a lot of them do, but there's like caveats and criteria, and they might convert it to cash and then move it. If it's not a straight like for like swap, or you have to pull the money out of the platform and then migrate it over, the issue you have there is you might be taking money out of an ISA and then putting it back into an ISA and using up your own allowance. You can get what are called flexible ISAs now, where you can take money out and put money back in and it doesn't actually eat up your allowance. But they're quite rare. I actually think trading 212s is flexible. I don't know for certain. I tell you what, we'll look into that. We'll leave that in the description.
Nice.
I like saying that because it just means that one of the minions in the back has to do some work.
Damo's like, I'm going to outsource this.
Yeah. Next to that, we're going to put a recipe for a gluten-free bagel. So enjoy that, Will. But yeah, there'll be a link to if trading 212's ISA is flexible, what that means and all of that stuff. But yeah, I think they're one of the more mainstream flexible ISAs, if I'm correct. So in that circumstance, you can take money out and put it back in.
This is news to me. I never heard of a flexible ISA before.
Yeah,
so is it quite a new product?
No, they've been floating around for ages, but they're not widely offered, and the platforms that did offer them were quite expensive, so there was just no point. But I think they're becoming more common, and trading 212 seems to be willing to go through the whatever work it is to offer those kind of products. I think because they've introduced a cash ISA, they're quite keen to let people be able to move money from one to the other, because I think the cash ISA has been really popular for them, and then they'll be able to hopefully convince people to move cash to the investment side. Who knows? Anyway, for me personally, I've got pots of investments on loads of different platforms, and I see absolutely no need to switch them. The only reason I would do it is if I was saving a considerable amount of fees. Obviously, there's the financial services compensation scheme to consider as well, which is the £85,000 worth of cover that you get if a platform kind of goes under. Now, it's unlikely that this will happen with any UK platform. They're heavily regulated under something called the CAS rules, which means they segregate your investments away from their own assets. So if a Vanguard or a Trading 212 went bust, all your money should just be sat there in a pot. And then
up to 85,000.
No, all of it.
All of it.
Yeah, because these are the CAS rules.
Oh.
So then what happens is they go in and they just go, okay, who owns what in here? Dish it out. The 85,000 cover is if when they go to look at that pot, the money's missing because a broker has robbed it, essentially committed mass fraud. Because if a broker goes bust, that might just be a bad business model because they don't make any money. But then if they've robbed your shares, that's when the cover will come in and be like, there's been fraud here, we'll pay up to £85,000. So actually the financial services compensation scheme cover is a last resort solution. The CAS rules are the main protection. But anyway, you might feel more comfortable having multiple pots below the 85K across different brokers.
So for all the big boys with lots of investments, it's better to spread it across different
platforms. I wouldn't say better. I'm just saying...
Safer?
I'm just saying peace of mind. People
sensible.
People might feel better about that. But, Some people like having everything in one place, so you can make the move. If you're buying UK funds and you can switch in, then that's okay. But if you've got stocks and things like this, you're going to be incurring all sorts of fees to sell out of those positions. And I think just leave it.
Yeah. Is that what you do?
Yeah, that's exactly what I do.
I've got my train 212, Hargreaves Lansdown, Barclays, ISA, all sorts of things. So I just leave everything where it is.
There's that Fidelity study, I think it was Fidelity, where they looked at who their best investors were and they found that they were all dead people. So they looked back at like the last 10 years and who were the most successful investors, and it was anyone who died who hadn't told the platform because they just left the money alone. So I think there's like an out of sight, out of mind vibe that if you go, okay, well, I've got this pot on Vanguard that's like 30K and I'm now going to go over to 212, and you just leave the Vanguard one, you forget about it, you come back in 30 years, you'd be like, holy shit, that's the one that's done well, because I've been over here tinkering
Yeah, you just
on the 212s. Yeah,
let the escalator ride up.
yeah,
just chilling.
yeah.
Can I ask a question?
Yeah. Have you got a mic? You need to mic the back of the room or something, don't you?
Yeah.
Well, maybe, I think T, maybe you asked this question. Just like you said, you can switch, but like how? Like you said, you can do it on the platform. I'm not sure I've ever seen that. Like, are you talking within ISAs or are you talking within platforms?
So if people can't hear Ruth, the producer in the background, she's asking about internal transfers of ISAs. You can do ISA transfers on certain platforms. Not all of them offer it. Portfolio transfers, they call them as well. But the functionality and features vary from platform to platform. Some platforms might not accept them going out. Other ones might not accept them going in. For a time, it was like they would transfer your platform, but they essentially sell everything and just bring over the cash balance. So you end up with like, you might say you've got 30K or 40K on one platform. You end up with 40K in cash on the new platform. But what that means is it protects your ISA allowances. You don't have to pull the 40K out and put it back in, which would use 2 years worth of ISA allowance. They're getting better and better. And now there are, so the concern is like for like investments. What I mean by that is if you're on a Vanguard or you're on a trading platform and you've got a 10 grand in Tesla shares and you want to move that to a Vanguard, they don't have Tesla on that platform. Or if you're in a Fidelity fund and you want to move to a Vanguard, it's not simple. It's not easy. And for me, I've always just looked at it and thought, I'm just going to leave my stuff here.
And I assume they don't want you to move to another platform, so they don't.
They really don't.
They don't make it the easiest.
I don't
process.
think the transfer process is the thing they want to streamline.
Yeah,
they're
they're
all,
not putting it on the homepage in like big letters. Transfer here. No.
They're all in it together in the sense of like, yeah, we want to make it as hard as possible for you to leave, really, because the assets under management is the money that.
I tried transferring my Barclays ISA once and gave up because it was just too complicated. I couldn't figure out.
Yeah, I have transferred into Vanguard, but this was a SIP, and that process was pretty smooth. For anyone out there that's like, oh, should I be consolidating pensions? It seems like a big blag. It's pretty easy. You just bang in the policy number and the amount you want to transfer, and it did it in a week. Other people have complained about the process taking months to do, but yeah, transfers are not the easiest thing to do, or the functionality isn't great. And just, again, you might incur fees. If there's dealing fees on the platform, say you're trying to get away from HL to move to a discount broker, there might be loads of fees when you exit in and in terms.
But if you're paying a lot of fees currently, you might want to move to avoid the current fees you're paying for better. Yeah,
definitely. But you get charged per trade and things like this on the likes of HL. So just be aware of the fees. I think a lot of people who pay fees on platforms like HL pay them by accident because they don't realise. You'll move £1,000 portfolio, you end up with 100 quid on the other side or something. Like, what the hell just happened? It wasn't really until I sat next to my mate Tamain on the podcast that I realised I was going bald in a big way. The sides of my hair were just going to the back of my head, which, for some men is fine, but for me, I think I'd look pretty weird if I was bald. So, not one to go bald gracefully, I started looking for solutions. Obviously, I could have gone to Turkey or got a hair transplant or whatever, but I wasn't quite ready for that yet. So then I stumbled across Manual and started using their services. I was really happy with the service overall, so I approached them and asked them if they wanted to sponsor the podcast, and they said yes. This couldn't be simpler. You just go onto their website, fill out a quick questionnaire, and then they send you clinically proven treatments through the post. No need for an appointment or anything like that. If you want to try out Manual for yourself, we'll leave a link in the description for you, and if you use code MM55, you'll get 55% off your first order.
This question's from Balmy B. Can you switch from an income version of a fund to an accumulation version without a financial penalty? I stupidly picked a Vanguard income fund when I started investing. I want to change it to an accumulation, but I'm not sure of the consequences of doing it. If that's your stupidest mistake, you're doing very well. I've made a lot more dumb mistakes than picking a income fund instead of an accumulation.
Yeah, it's not even that stupid, really. People do it all the time. What's the difference, T?
Oh, put me on the spot. No, an income fund is when you get your gains, it gets reinvested. No, you get it as a dividend, but then an accumulation fund, it gets reinvested into your portfolio.
Yeah, so it
automatically reinvests. Yeah. Come on, I'm learning stuff on
gains.
Learning stuff on this podcast. Gains.
Yeah. So I don't think it's a stupid mistake. I think it's one that people make all the time. I think, let's say you're on a Vanguard platform. They're listed at the top now, so they do the INC and the ACC versions of the funds.
What's the INC and ACC?
Income and accumulation.
I should have known that.
Yeah, you should have. I think again, if it's listed in pounds, there shouldn't be any financial penalty from moving from one to the other, because there's no dealing fees and there's no FX fees, and you don't pay stamp duty on funds, which is the UK tax. So assuming that your platform doesn't charge fees for trades of any sort, if it's an ETF or an index fund, then you should be okay. If you're on like a HL though, they will charge you, I believe, for ETFs, because they charge a dealing fee on ETFs. I don't know all the fees off the top of my head for everywhere. The long and short of that is you just need to check if there's any fees for buying and selling funds. And then if there's not, you should be okay. If it's a fund listed in dollars, euros, or any other currency, you're going to likely have an FX fee from switching. In that case, I wouldn't switch. I mean, to be honest with you, I wouldn't switch at all. I would just leave it there as like a reminder of, your own stupidity for the rest of your life. And for me personally, I actually buy income funds because I love that little dividend payment.
Yeah, and then would you spend it or reinvest it?
No, reinvest it.
So you could just do it accumulation, but you like the process.
Yeah, I like the process. I'm just
it's not a stupid mistake. It's you can just enjoy your dividends and then reinvest it yourself.
Yeah, like one of my mates is a smoker, and he smokes rollies, and he's like, I just like the mechanics of it. I like to be involved in the making of the fag. It's like, all right, do you know what I mean? So, and like people who have those crazy vapes where they're, they've got all the juices and the coils.
And they want to like make a little concoction together.
Yeah. I think they're just
mad scientists.
I'm kind of like that, like with the dividends. I just like to, be involved, and I think the notifications are good, and watching them every quarter get bigger and bigger and bigger is a nice feeling. Nice. The accumulation it's a bit too passive for my liking. I like the notification. So, I don't think you're an idiot. I think people do it all the time, and I don't think it's that big a deal. And as long as there's no dealing fees or fees for buying and selling on the platform, you probably can just switch without it being an issue. Unless it's a foreign listed fund, then there'll probably be some FX fees to consider. But yeah, lighten up on yourself, Barmy.
You're doing all right. This question was emailed in by listener Harry. We're in the process of moving house at the moment, which means, for the short term, we will have around 90k hitting our bank account from the sale of our current property. Nice. This money will be used as a deposit on our next home when we finally can purchase, but it will be with us for around 3 to 6 months and potentially slightly longer. What are the best options we have in order to get the most out of this cash sitting with us? ISA, savings account? Is it best to split the cash into different areas rather than just one place?
Slap it all on red.
Yeah, come to the casino with me and Damo. We'll sort that out for you. Don't worry about it.
Yeah, it'll either be the best or worst night of your life. Like, how many times in your life can you guarantee that this is either going to be the best or worst night of my life? That's the kind of like night I like. Do you know what I mean? Anyway, don't do that. So don't be taking risks with your house money. Play it super safe. So, you could do money market funds and things like this, but I wouldn't even do that. It'd be savings account for me. The problem with an ISA is you've got a lot of cash there. You'd be filling out your ISA allowances. I think people should be using their ISA allowances for investing long term, not for cash personally. So I would be banging it in a savings account. The thing that you've got to consider there though with a savings account is your tax-free allowance on interest. So everyone gets a certain amount of interest that they can earn for it tax-free, depending on their tax bracket. So a basic rate taxpayer, which is 20% bracket, is 1,000. The higher rate is 500. An additional rate taxpayer gets nothing. £500 worth of interest when you're earning 4% on nearly 100k is not that much. You would quickly go into the position where you start needing to pay tax on the interest. So you've got 2 people, 2 allowances. So you'd split it in that way to answer that question. And then if you're thinking, well, this money's going to be there for 3 to 6 months and we're going to end up going over that, maybe you might consider premium bonds. Premium bonds really are like, they're only really beneficial for people with lots of money in a way. They're a lottery. So
Yeah, they're the ones you win a prize.
Yeah.
Like random person wins a prize.
They're the most popular investment vehicle in the UK. There's about 120 billion pounds stored in them, and they're just a lottery essentially, where you buy bonds from the government and then they do a lottery every month, and off the back of that they give out prizes, and the top prize is £1 million. The problem is that the average payout at the minute will be around about 4%. But for one person to win £1 million, they take the 4% off all the other people, right? So with average luck, the average person should receive a benefit of 4% a year through being in there. But a load of people will be really lucky and do loads more. Someone's going to win £1 million every month. But then there'll be millions of people who underperform that average. The benefit though is because it's a lottery win, it's tax-free. So if you've got like lots of cash and you're already hitting the interest allowance, so to the point where you're being taxed on any gains above that, let's say you're a higher rate taxpayer and you know that any interest that you get on tax above 500 quid, sorry, on that is getting taxed, maybe you consider putting it into premium bonds instead, because any winnings will be tax free, and it's, you know, super safe in the sense of it carries pretty much no risk because it's government backed. So yeah, do the savings accounts. If you're going to exceed whatever your personal tax rate allowance is for interest, maybe look at premium bonds beyond that. I'm sure there'll be loads of people below with other suggestions as well, so check out the comments. I think one benefit of the world we live in at the minute is that savings accounts have got pretty good rates on them. You can get like 5% in some cases. You could maybe look at a high interest savings account that locks the money away for a period of time, but it sounds like you're just waiting for the keys to this house. And what happens if you lock it away for 6 months and then it's like, oh,
3 months later
we need the money. Yeah. So I'd just
want something easily accessible.
Yeah,
so
instant access savings accounts. I'd, maybe about 4-ish% or something, and think, well, if it's in there for a year, we're getting near £4,000. But then again, consider tax, maybe premium bonds. But yeah, don't be taking risks with your house money.
Definitely.
Right, I got a joke for you. So, knock, knock. You say, who's there? And I say, sorry, I can't tell you because of GDPR. Compliance banter is pretty rubbish, isn't it? But it's even more annoying when you're trying to grow a business and your sales are being blocked because you can't prove you're compliant with things like GDPR and ISO 27001 or SOC 2. These are security standards that a lot of companies insist you have before they'll do business with you. But proving your compliance with these standards can just be a bit of a nightmare, taking the best part of a year in some cases. The good news is we're working with Vanta, who can get you up and running in a few weeks rather than a few months. Their focus is making this stuff easy so you can spend as little time on it as possible. So if you need to prove your security practices are in order, and if you want $1,000 off, head to vanta.com/makingmoney.
Next question. Mark asks, given the current freeze on the tax-free lump sum we are likely to see, what would you do with yours if you were 55? I.e., would you leave it where it is inside the SIP, or would you transfer it over time into ISAs or something else?
Casino. Red. Best or worst night of your life? No, for me, I think this is one of the biggest mistakes people make with their pensions. They get to the age where they can access their 25% tax-free and think, yes, need to do that, take it all, and then they're just sat there with all this cash and they're like, well, I don't know, I'll go on a holiday and maybe I'll pay down the mortgage, and yeah, what do you do then? Whereas they could have left that invested in the market, let it continue to grow and compound and generated returns and boosted their pension pot even bigger, and every single month take a chunk of income tax free. What I think most people forget is if you don't use up the 25% tax-free cash, you can use that spread out over the lifetime of the pension essentially.
Yeah, so it's not like you have to take it 25% out in the first year or before you're 60. You can take it out whenever. It's 25 throughout for the rest of your life.
Yeah, so if you've got like £1 million, say, and you could take 250 grand tax-free, you could spread that out so that you can become really tax efficient. And then a combination of that and your ISA, you could be drawing like 50k a year in income completely tax-free. And the benefit is, as soon as you take it out of the pension wrapper, that 250 grand, where you're going to, like in this example, where are you going to put it?
Yeah. If you stick it in the bank, you're losing value.
Yeah, you let's say you can achieve 6% inside of your pension or 5%. Wherever you're going to put that money, you need to generate a return better than that. Plus, it's probably going to be taxed, that return, because you can't slap it inside of an ISA. I think people they think because they can, they should. And I think people should sit there and question, do I actually need this money? Yeah. If not, let's just leave it in there. Maybe you take a bit of money. You don't need to take the full 25%.
A little cheeky holiday and then, just leave the rest in there. You don't
treat yourself, live a little, but you don't need to take the full 20. I will be planning not to take the full 25% because I think it's much more powerful to have this like tax-free income at all times.
Tim asks, what vehicles would you use or recommend to supplement DB pensions that are often reduced if taken early? I'm in my mid-50s, a basic rate taxpayer and late to the investment world, but I'm now using an employer AVC, a SIP, and an S&S ISA to build different pots. Is there an advantage to spreading your options like this, or is it more advantageous to stick to just one choice? There's a lot of technical jargon. DB pensions, drum and bass pensions, something like that. AVC, SIP.
What's an AVC then?
Additional voluntary contribution.
There's no way you got that right.
No, come on, it's got to be, mate. I know my stuff. I don't know what DB page, drum and bass pension is.
Defined benefit.
What's that mean?
So the benefit
the work give you additional money.
The benefit you get at the end is predefined. So I just tell you what it is by telling you the same name.
Just repeat it with the longer word with the full name.
What I mean by that is like final salary and things like this, where you work for a certain period of time and then the employer guarantees you a set income for for life or whatever. And normally the longer you work there, the more you get.
Are they common?
No, not anymore.
They were more common before.
There's lots of people with them, but they were all like the Gilded Age. No, I think nowadays most people have defined contribution DC, which is the amount you end up with is defined by how much you contribute. By how much you pay in.
And AVC, additional voluntary contributions when you add more money into your.
Go on, let them cook.
Into your pension, and then your work matches it.
So I think it's with the defined benefit schemes, you buy extra years. So if they say, because his question there was about, if you access a defined benefit scheme early, you lose money or lose years. I think they have this within the NHS as well. They basically say, if you want to access it before 67 or whatever, you get half the benefit. Yeah. So I think with the AVC, you can buy extra years. So you put more money in and they will give you more full years of payment. Yeah. So if you want to retire a bit early, you can bring that closer to you or whatever. SIP.
Stocks and shares. Self-invested pension plan.
Personal pension plan. It might be pension plan. I get it wrong every time.
We always change it. We decide what it is. Yeah. It is what we say it is.
Yeah. And then stocks and shares ISA.
Yeah.
So the question here is the advantage of spreading options. So whenever I look at it, the best advice in terms of the numbers tends to be the pension options are always deliver the most value. And I dare say a defined benefit pension is going to be worth more than pretty much anything else, because that's why they're getting rid of them, because they're so expensive to maintain. But there's a massive advantage to having a bit of everything because it gives you the most amount of flexibility. The stocks and shares ISA can be used to, supplement other incomes, or can be the vehicle that gets you to early retirement. So you could, with the DB scheme, let's say they say you can't access it until you're 60 and you're mid 50s and you want to retire in 12 months and you've got a stocks and shares ISA that could just carry you to the point that the DB scheme kicks in. I want to retire at say 50 and I'm going to fund that through my stocks and shares ISA to the point my SIPs and pensions kick in. And I think from a tax planning perspective, most of financial advisors that we speak to say their ideal client comes in with, I got a load of money in a stocks and shares ISA, I got money in a SIP, and I got a few other pension schemes from previous jobs, because it gives them the most ability to structure that tax efficiently. If you've only got one to draw from, well, you're subject, you've got no room. So whilst it might be technically better to focus all on pensions, I think having a mix of everything just gives you plenty of options.
Yeah, and you do want flexibility later in life, don't you?
Yes.
No, you don't.
Do your Pilates. Do the Pilates.
Dan asks, I've already unintentionally had several dumps in the Irish Sea. thanks to United Utilities, paid heaps into energy company bosses' pockets over the past years, and would like to avoid being part of the problem or beneficiary of said company behavior. What should someone just starting up do to make ethical investments without having to go to the individual stocks route with zero knowledge of the market? Is it possible? So yeah, he doesn't want to contribute to these companies polluting the planet, and he doesn't want to make money that is not ethical, I guess.
Yeah.
Or that's damaging the planet.
Yeah, I don't think it's possible, personally. I don't think it's like, it's like saying, how can I make sure that a company meets my ethics without any involvement, in the sense of I don't want to value the individual companies. I don't really know what's going on. If you don't know what's going on behind closed doors, you can't make sure, can you? I think the ESG fund thing, you could do, that's the off-the-shelf version. So environmental, social governance funds. So you can pick up those, and yeah, that's the, like, I want to be ethical, but I don't want to put much time into it. You could buy one of those, and you could maybe have a look at what the fund does. So under the index, it will list the type of index that it tracks, or the fund, or what they're aiming to achieve, and that'll normally say, we are a fund that doesn't like fossil fuels. We're a fund that doesn't want to shit in the Irish Sea, whatever it is. But I find that even those, you'll get these broad ethical funds, and then people will say, "Oh, I buy that because I care," and then you'll look at the components of the companies, and they'll be like, "Oh, I don't really like that business," or "Oh, no, I didn't know it was investing in Facebook," or they're very broad.
And it's hard for any business to be like 100% ethical or 100% ESG, because they might say, okay, we've got renewable like energy from our solar panels, but then they deliver their product with trucks which pollute from driving around on the roads all day. So there might be aspects of the business that you don't think are ethical, even though they're making big efforts in other areas to be ethical. So it's kind of because they've got to make money, and so they might have to pay for fuel, pay for transport, carbon emissions, all these things. So it really depends. I don't think you can just look at it overview. You do need to go into detail and look into the company.
Yeah,
if you want to be truly ethical.
I think a good type of fund that does this well for a certain subset of people will probably be Sharia funds, where they but they're so well defined in terms of like, this is the thing that we want you to exclude that they do well. If you're just saying, I want to be good, you're going to find it hard, because you need to define what good is. In terms of then investing in individual companies, you can do that, and you can try and buy individual companies that fit your morals. But are you buying good businesses? A good example of this would be Oatly, right? So many people bought Oatly because oat milk, and no one wanted to drink cow juice. But it turns out it's a terrible business.
Cow juice sounds so wrong.
Kind of, that's exactly what it is, mate. Like, I could have called it something weirder, but yeah, it's cow juice, isn't it?
Oatly, but yeah, they bought oat milk because they thought it was better.
So they bought Oatly because they thought, this is a great company. This oat milk's the future. Oats and water, like, revolutionary. And the company's tanked because it wasn't a good investment.
So you mentioned Sharia funds, which is like a type of Islamic banking. Do you want to break down like what the rules are and how they make their money, how it works?
Yeah, you're going to have to help me out here so we can remember them all. But they exclude any business that generates the majority of their profits through the sale of pork, guns,
pornography,
alcohol. They also exclude a lot of financial institutions that charge interest. As well as that, they look to clean bad sources of income, such as any interest generated from a business, by donating that money to charity.
Yeah, so
pretty stand up,
pretty ethical, pretty stand up. Yeah. You can look at that.
Yeah,
make you feel good.
Yeah, well, with Nest, which is one of the largest work-based auto-enrollment schemes, the only fund that they have, which is 100% equity, I believe, is a Sharia fund. So it's either Nest or the People's Pension. I think it's Nest. But yeah, that's the only fund I would personally use on their platform, because I want 100% equity. So that is Sharia.
But then it's got to line up with your own ethics, because if you don't find anything ethically wrong with alcohol,
you might want the pigs, the drugs, the porn,
and the guns. Yeah, you might want it all. So it depends on what your ethical outlook is.
Yeah.
Paul wrote in and said, "I've just recently started listening, and this has got me to start investing. Thank you very much. Thank
He's
you very
got
much.
a little muscle emoji.
Yeah, I patted myself on the back, but yeah. My question is, as I've got a couple of old work pensions from my former workplaces just sitting there, I don't know what the best thing to do with them is. Number 1, leave them. 2, move them to my current workplace pensions. Or number 3, move into another place. If so, where?
We can't give financial investment advice, and this is one thing that is definitely like investment advice, because it varies so much individual to individual, because it depends on the pensions that you've got. You might be sat there, Paul, with an NHS pension, and we're like, oh yeah, just whack them all in a sip, and you lose all your defined benefits. So what's important to understand is, what benefits am I giving up by moving out of those pensions or consolidating them? You say leave them. I'm guessing what you mean is leave the money there, just sat there, not like oh, sack it off, I'm done. You might find that consolidating pensions into a SIP or into your current work one gives you more choice over how it's invested, and that means that you can reduce the fees. But the key thing is, what benefits are you giving up by consolidating those pensions, especially if your pensions are older? So the older they are, as in, are they from the 90s or the noughties, the more likely they are to have attractive benefits. It's not all just about fees. There can be things like guaranteed annuity rates, or a guaranteed tax-free cash lump sum that you can take from them as a percentage and things. These are like really valuable benefits that are worth more maybe than even the fees. So if we're talking about large sums of money here, you would probably sit down with a financial advisor and they would take a look and go, yes, you do this or don't. If you're talking about small little pots that you've built in the last couple of years, then maybe you might want to consolidate them. I'm sorry, we can't give you a direct answer, mate. But if I just said consolidate them, there'd be people out there that would do the wrong thing and cost themselves a load of money. So yeah, sorry, Paul. Do you know Paul?
I know a Paul. I know a couple of Pauls. But I don't think I know this Paul.
Couple Pauls.
Couple Pauls.
No, a couple Pauls.
No, a couple Pauls.
I'm a Paul.
No, you're not. Damien Paul Jordan?
Yeah.
Ah. Yeah. Are you ours or?
Yeah, I'm here.
I'm a Christopher by that way.
Are you?
Yeah, Tamaine
Timian Christopher Accarelli.
Tamaine Christopher Accarelli. This guy just butchering my name.
That's what I have to say to Siri. Hold on, one sec. Hey Siri, call Timian.
Calling Timian Accarelli. Ho.
Why are you just butchering my name?
Timian Accarelli. Timian Accarelli.
Why does Siri go, mm-hmm? What is it?
Calling Timian Mackerel.
Tie my mackerel.
If you're looking to get started with your own personal finances, we put together a 2-pager that can help people. So it just covers 80% of everything you need to know about your personal finances on 2 pages. You can get it by using the link in the description. You got to look at it?
2 pages, just how I like it. Short and concise.